In order to understand Web3, what we believe will be the next evolution of the internet, we first need to understand where the internet has come from, and specifically the eras of Web 1 and Web 2. Web 1 was the very first iteration of the consumer internet. This version of the web was defined by static web pages where users were limited to reading content. Beyond this, users could not interact with web pages in any meaningful way. While Web 1 did not offer the most seamless user experience, it provided tech-savvy developers with certain advantages thanks to its open source and user-owned nature. These features allowed content creators to own the platforms they created and to reach their audiences directly and reliably without having to lease a domain or account from a governing body. Web 2 was the next step in the internet's evolution and represented a significant change not only in the web's power structures, but also in the ways that users would come to interact with the web. While users were limited to reading content in Web 1, Web 2 allowed for much greater interactivity, what we refer to as the ability to read and to write. Importantly, Web 2 made the consumer internet much more user-friendly, and it extended the ability to create content on the web from software developers to the everyday user. We take this for granted today, as almost everyone can quickly and easily reach global audiences through apps like YouTube and Instagram. While Web 2 democratized content creation, it also had its limitations. One such limitation is that the influence and control over the web became highly concentrated in a handful of centralized companies that own today's most popular platforms. Instead of individuals owning their content, as was the case in the Web 1 era, user data and content today is generally controlled by third parties. The result is a web that is permissioned and censored, with a select group of companies dictating how the majority of the people interact with the web. Now, Web 3 is the next step in the evolution of the web. Web 3 is an attempt to combine the open source, neutral foundation of Web 1 with the interactive, content-rich platforms of Web 2. Web 3 is also an attempt to disrupt the paradigm of influence and control of today's web, allowing users to have full autonomy over their web experience rather than being subject to the rules of arbitrary actors. By leveraging blockchain infrastructure, Web 3 can allow users to not only read and write, but also provably own value on the web across a rich ecosystem of applications and web pages. With the potential to be the next iteration of the web, we believe that Web 3's adoption can be driven by many of the same factors that catalyzed adoption of the internet in its earliest days. The reason for this is that both the internet and blockchains are base layers that host and enable access to ecosystems of web pages, applications, and utility online, making them a prime candidate to benefit from powerful network effects. In the early 1990s, the general utility of the consumer internet was limited, as was the audience. As more users were slowly onboarded to the web, however, access to the web became more marginally valuable. Of course, larger audiences on the web provided powerful incentives for businesses to capitalize on this new frontier as well. It is no surprise that this new era saw massive investments in the internet, both in hardware and software capabilities, as well as the rise of many of today's internet giants. Due to this huge capital investment, the utility and functionality of the web experienced significant growth, which incentivized even more consumers to get online. These are network effects in action. The early days of Web 3 have exhibited many similarities to this path. Driven by a symbiosis of complementary developments in hardware and software, and supported by significant capital investments, the utility and functionality of Web 3 applications is rapidly growing. Based on an analysis of the Ethereum network, which is the leading ecosystem powering today's Web 3 movement, we're seeing similar network effects drive exponential adoption. Should these network effects continue to gain momentum, we are confident that the Web 3 landscape has the potential to become a permanent fixture in our everyday lives. One of the segments that has garnered considerable attention and product market fit within Web 3 is decentralized finance, or DeFi. The main objective of DeFi is to create a decentralized and permissionless alternative to the traditional financial services industry. Over the past half decade, DeFi has made significant technological strides that have allowed it to flourish into diverse ecosystems of applications, offering services from asset exchanges to lending and borrowing to insurance and much more. Importantly, because DeFi leverages the costs and operational efficiencies of smart contracts and blockchain technology, DeFi applications can provide these services without the need for middlemen to ensure that counterparties honor their commitments to one another. The result is a financial system that is incredibly fast and cost efficient, but which also has very low barriers to participation for users around the world. A great example of the cost and operational efficiencies of DeFi is the transfer of value using stablecoins. Stablecoins are tokens that are pegged to fiat currencies such as the US dollar and which are secured by blockchains. Stablecoins transfers settle nearly instantaneously. The cost of transferring stablecoins is also a fraction of what it costs to wire funds using traditional methods. In fact, a report from the World Bank cited a cost of about 6% to wire $200 internationally, which stands in stark contrast to a cost of about less than 0.1% when using high-throughput blockchains such as the Solana network. Because of these efficiencies, we believe that there is potential for substantial value discovery from the integration of DeFi protocols into the backends of many of the fintech apps we all know and love. This approach could benefit all parties involved. DeFi protocols could onboard a new pool of users and benefit from the sleek and intuitive user interfaces of popular fintech applications. For fintech companies, the cost or operational efficiencies of DeFi could significantly reduce and open doors to new and novel product offerings. For users, this integration could result in more secure, high performance, and lower cost of financial experiences. Another incredibly exciting segment of Web3 is the blockchain gaming space. Blockchain gaming has the potential to reimagine how gamers interact with games and how in-game economies are structured. In today's gaming industry, gamers are essentially sidelined consumers. While about 40% of revenues earned by gaming companies come from purchases of in-game assets and microtransactions, gamers do not actually verifiably own the assets they buy. Moreover, while esports are growing into commercialized industries, the ability to monetize gaming time is limited to a very small group of participants. Blockchain gaming seeks to change this paradigm by allowing gamers to monetize their gaming time and to verifiably own in-game assets, some of which can carry significant value. Together, these traits introduce the ability for gamers to reap the benefits of their in-game accomplishments. Currently, the blockchain gaming sector is being heavily invested in, with at least $6 billion of venture capital flowing into the space in the first half of 2022 alone. Blockchain gaming has also quickly emerged as one of the leading drivers of adoption of blockchain technology, with the number of active users of blockchain games as measured by unique wallet addresses surpassing that of DeFi users. With a slate of high quality and hotly anticipated games set to be released in 2023, we believe we are in the cusp of glimpsing the true potential that the blockchain gaming industry holds.